welcome to the show.
All right.
Dunkin' Donuts commercial.
Another crazy week it was.
I've stopped saying it because it's every week.
Yeah.
I'm just going to give it to like 2028.
Big news this week, though.
Pope.
What?
The Pope. I was
the
joking.
Pope. Oh, yeah. Well, that was big news. Actually, they picked an American Pope.
Yeah.
That is astounding to me.
Nothing is astounding anymore.
I especially this day and age, I wouldn't have expected it.
I wouldn't have expected anything like this. I mean, I'm not a Catholic, but I got a lot of Catholic friends. So they were all excited yesterday, and I get it. It's a big deal. But not to get religious. It's nothing to do with religion, really. It's just, everything's politics now. Everything's kind of what the, what it looks like and what's going, and I guess it's always been that way. This isn't new. It just seems to be so much more transparent now because of so much media, so much social media, so much everything. It's so hard to tell. It's so hard to have a filter now. We used to have it filtered for us. We trusted everyone that was on the TV. There was only like 4 or 5 of them, and you trusted them. Who knows, right? Now it's just there's thousands.
It's a free for all,
and it's really hard. It's something that I've been spending a lot more time on lately. Is better filtering mechanisms, right? So one of my filtering mechanisms is just not to watch it at all. That's not very good because I do think that what's happening in the world has a practical application to investing, right? Doesn't necessarily mean it's going to tell you why or how before.
Right.
We always talk about that. It's not a leading indicator, right? If you know that term, it's not telling you what's going to happen. It's telling you what's happening. Mm-hmm. You can infer from that, but you never know what caused it until after it happened. Right. But if you're blind to what's going on, that's not very useful. So, but it's just a matter of filtering it down to a level of data that you can actually process because there's just too much. There's way too much.
Yeah. One of the things that definitely happened this week that is kind of a way that macro analysts in the market look at it. The administration, we did the 10% tariff across the board, and then we came out with reciprocal tariffs, and then 145% on China, and it just kept going and going, and the market was falling. At some point, the news isn't going to get any worse on that, and the only way it can really go is up. And this week was a big one because when they came out with that deal with the UK, it's a huge deal. It's a huge deal in terms of the actual deal that they did. But what's more important is it is clearly going to be used as the kind of the go by for all the other 17 countries, as Besant likes to say. Maybe not China, but it's a big step in the right direction.
It definitely sets the stage for every other negotiation. That's a given. I don't know enough about the current state of affairs between U.S. and Britain or UK to really grasp. Was it like kind of a given that they were going to kind of be our ally on this and kind of figure it out and all that, right? I don't know. I don't keep up with big policy agendas as much as I did when I was in the Gov. But, yeah, I mean, it seems to me like it was reasonable that they would have been the first ones to kind of work a deal. It certainly wasn't going to be China, and it certainly wasn't good. But so as we're kind of going with that is I'm going to be more impressed once we make a deal with China because we still aren't getting our stuff from Britain.
Nope.
This piece of plastic here did not
come from Manchester.
No, it came from China or somewhere like that. I don't know exactly. I'm sure Duncan has figured out a way to hide where it comes from, but it didn't come from Boston. It didn't come from Britain. So, yeah. I don't know. I mean, I still think it was a good deal. I was kind of hoping because I think you're right with the whole I don't know how much worse it could get and mean anything. Like maybe it could get worse, right?
Sure.
But I don't think it would phase any. I think everybody's numb at this point with all the bad news and then seeing that it didn't really do anything. Maybe it did a little bit. I think that's the kind of sense I'm getting when I can't poll a million people or anything, but I'm trying to ask like normal folks, like what did you do or what did you think when this happened or this happened, and they're not.
Yeah.
Now these are obvious retail investors, but that's another thing that seems to be shifting. Most of the research I've been able to find in the last couple of years has shown it shouldn't be a surprise that retail investors are having a much bigger impact on the market than they were 5 years ago, 10 years ago. It's happening because so many people have a trading instrument in their hand. Yep. I just made a trade before we got on this, before we got on this podcast, right? It took me 30 seconds or so. And the only reason it took that long is because the site went down for me or whatever. Like I couldn't log in, but yeah, it's so in your face. You can trade so easily. And, so they're having a much bigger impact. I think that's a bigger deal. So if those folks, right, who aren't really able to keep up with everything in the world are just kind of like numb to it, and you're just like, I don't know what they're talking about, but tariffs are bad. Then all of a sudden tariffs are good. Tariffs are bad. I don't know. Yeah. I don't know. I'm eager to see how the rest of the summer goes. Is it still going to get back to historical trends where this is the kind of the
slow part of the year.
Slow part of the year. Is that ever going to change? Because it used to be that way because the big investors want to take the summer off, right? They go off to Connecticut or whatever, where it's not 90 degrees. And I don't know. Is that the way it is anymore? People seem to be trading 24/7, 365. Yeah, I don't know.
This year is up for grabs. It's going to be interesting. I think. I'm pretty sure. I think there was 1 year in the last 100 years. So we talked about this a while ago. But if you chop up the decade into individual years, and you look at a chart of all the 1 years, the average of all the 1 years, all the 2 years, right? There has been 1/5 year in a decade that was negative, and it was barely, basically flat. In forever. For whatever reason, the 5th year of the decade is never a down year. And if there was ever going to be a 5th year of a decade to be down, this is it.
I think it just goes back to what we were talking about a minute ago, though. I didn't really say it this way, but the gloves are kind of off. There aren't any rules anymore. It seems like, and I don't just mean the current administration. I mean just everywhere you look, right? When you talk about retail investors having a lot more impact on the market, you talk about the political climate that we have. Good or bad, however you read that, it doesn't really matter. It's definitely different.
It's chaos.
You have to accept that this is the most chaos we've had in our government in a long time. I'm not saying it's a bad thing, right? I'm not saying it wasn't needed. So don't read into that. I'm just saying you can't ignore the fact that this is chaos. I know what chaos looks like, and that's what it looks like. And again, a lot more retail investors, and then also, so what does that mean? Does that mean that this is an anomaly and it goes away at some point, or does it change it completely and that we never get back to normal? This is the new normal. That's kind of what I want to try to figure. I'm not going to figure it out, but watch people who are a lot smarter to figure out, is this an anomaly, right? When I say anomaly, 2-3 years, or 1 year. This is the first time that year 5 has been whatever. Okay, great. Now there's been 2 because there was another one. Yeah. So now there's 2, but then it goes kind of back to normal. That's the kind of things I think we should be focused on is have things changed so much? Because these people say about with COVID, remember, this is the new normal. It really wasn't. We've kind of gotten back to what we were pre-COVID. Have a few things changed? Absolutely. Yep. But by and large, if you look across, it didn't have as much of an impact. I don't want to diminish what happened. Yeah. So you guys don't read into that. I'm just saying that we're kind of back to normal. Yeah. Yeah. Whatever that is. And so that's the difference, right? Is if something like this happens and there's chaos and craziness or whatever. But I think it's tend to be because, particularly in America, we're fickle. We're short-sighted. We forget really quickly. Yeah. So anyway, we haven't even gotten into the podcast
I know. Yet. Last thing before we get into this thing. Because I watched it last night. Neil Howe, if you ever read his stuff, he wrote a book called The Fourth Turning a while ago, 10 years ago probably, and wrote an update to it pretty recently. And he was on Thoughtful Money yesterday, and he had a really interesting perspective of Trump and the policies and what needs to happen going forward to complete the fourth turning. And it was one of the best YouTube hours I've spent in a long time. Highly recommend checking that one out if you want to get a little bit of a different perspective on come from that you won't hear about anywhere else probably.
Yeah, it's they don't really put him on mainstream media that much. He's been out there a little bit, and the other guy, Ray Dalio, Ray Dalio spent a lot of time writing about kind of cyclical, historical kind of things. Yeah. It's very similar, but not exactly the same. So, I would recommend you go look at both of those, and you can find a lot of summaries. You don't have to read I don't even know how, I can't remember how large the book was that he wrote, but it's
pretty big
and pretty dry.
Yeah.
Point is,
it's a lot of demographics and stats.
Go get the YouTube versions, and Dalio does a great job of putting out YouTube version videos of like his whole book, and like, okay, if you need the 15-minute version, here we are.
And it's a comic book basically.
And
the videos.
And it's awesome though because
really
whether you believe it or not, it's not just a couple of guys in their thought, that they're just wackos. Like these folks have spent decades and decades researching this stuff, and they're kind enough to share it with the public as opposed to just keeping it in academia, which is what used to happen. You didn't get access to these smart thinking, kind of strategic stuff. So anyway, take a look at it. Jay's right. It's definitely worth an hour if he gives an update. I haven't had a chance to look at it, but I saw that it came out, and I'm really interested in it because it's just, it's based on facts, right?
Yeah.
Anyway, let's rock and roll.
Here we go. May 11th. So we'll take a look at what happened this week, which one thing we didn't talk about was there was a Fed meeting this week. So we'll take a look at what happened at the Fed meeting, which feeds into this idea of stagflation. Last week, it was Thursday, April 24th, I think, we had a thing called the Zweig Breadth Thrust, which is a super bullish occurrence. It's only happened 19 times in the past 80 years. And the technical analysis world was all excited about the most recent Zweig Breadth Thrust. So we'll take a look at that.
I would recharacterize that as giddy.
Giddy, yeah.
They were.
Do you hear about that?
Of course I did.
Yeah.
Every technical analyst person I follow on Substack was giddy.
Yeah. So we'll take a look at that. And then Bitcoin, we've done that a few times before, but we had a big breakout in Bitcoin, so we'll take a look at that. And then TSP fund charts. All right, so Monday, we get global U.S. composite PMI. So producers manufacturing index revised down to 50.6 in April from a preliminary 51.2 and well below March's reading of 53.5. So latest figure signals the weakest expansion in the U.S. private sector since September 2023. So the economy continues to weaken. S&P was down 0.64%. Tuesday, U.S. imports of goods and services. So we talked about it last week. This is basically the trade deficit. How much more are we importing than we are exporting because we're trying to get ahead of the effects of tariffs. So imports jumps by $17.8 billion or 4.4% to a record $419 billion in March as businesses and consumers accelerated purchases ahead of expected price hikes following new tariff announcements by the administration. S&P is down 0.77%. Then Wednesday, the big news was first, the president comes out and says he is not going to decrease tariffs on China as a tool to bring them to the negotiating table. So that wasn't good. But then the FOMC, the Fed, comes out with their statement in their press conference. They kept the Fed funds rate the same. The Fed funds rate is a range, and it's between 4.25 and 4.5. So ordinarily you hear that Fed funds rate is 4.3%. It's because they picked the middle point between what the actual range is. But we're going to get to kind of some of the fallout from that. S&P is up 0.43%. Then on Thursday, you get initial jobless claims, 228,000 versus 221,000. So not that big a deal, right? Not that many more jobless claims than we had last week. The 4-week average jobless claims rises a little bit, right? 1,000, 227,000 from 226,000. So unemployment is very stable. And then we get the trade deal announced in the middle of the day on Thursday, and that pushes the market higher, and the S&P is up 0.58%. And that I think carried over into Friday because there wasn't any economic news in the trading economics calendar, but a whole bunch of Fed board members were giving speeches today, and the market was up. The S&P is not up that much, like 0.5%, but some other things are way up today in the morning. So Fed does this meeting on Wednesday, right? It's got two mandates: stable prices, which basically means inflation. If inflation is going up, prices are going up. If inflation is going down, prices are going down. So they try to keep inflation stable so prices stay basically the same. And low unemployment. So those are supposedly, the only two mandates that the Fed has. So Powell comes out on Wednesday in the statement and says this: if the economy remains strong and inflation does not continue to move sustainably toward 2%, right? Which means he's saying if the economy stays strong and inflation stays high, stays elevated, doesn't need to go up more, but just does not move down towards his 2%, then we can maintain policy restraint for longer, right? If the economy remains strong, right, meaning unemployment doesn't go up, and inflation kind of stays high, if it doesn't continue to go down to his target, then he can keep interest rates high, right? He can maintain policy restraint for longer. If the labor market was to weaken unexpectedly, right? If unemployment goes up, that's what he's saying, or inflation were to fall more quickly than anticipated, right? Then they can ease policy. They can decrease interest rates. So our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The problem is the dual mandate is generally in conflict, which is fine because it's usually 50-50. But when the overall bar rises, that's the problem, and that's what stagflation is. So in the statement, he says, the committee is attentive to the risks to both sides of its dual mandate and judges that the risks of higher unemployment and higher inflation have risen. Okay, so that's his first real kind of nod to this idea that we could be going into a stagflationary environment. So stagflation is a combination of high inflation and stagnant economic growth and elevated unemployment. So you got high inflation, the economy's not growing, and unemployment is going up, right? Usually it's a seesaw. In this case, both ends are going up at the same time, which is stagflation. It doesn't happen very often. But we're going to take a look at a chart on that. It gained broad recognition in the 70s as a series of global economic shocks, particularly the 73 oil crisis, disrupted supply chains and led to rising prices and slowing growth. Okay, stagflation challenges traditional economic theories, which suggest that inflation and unemployment are inversely related, because as inflation goes up, unemployment should go down and vice versa. Stagflation represents a policy dilemma as measures to curb inflation, such as tightening monetary policy, can exacerbate unemployment. So if you're trying to decrease inflation, you do that by raising interest rates. If you raise interest rates, it increases unemployment, right? So as long as the seesaw is 50-50, you're good. When one of them gets out of whack, it's very, very difficult. And when both of them go up together, you got a big problem, and that's where they're at right now. So this is what it looks like if you're going to look at it on a chart. They talk about the 70s as being the big stagflationary period, right? So the inflation rate, year-over-year inflation rate is in black, okay? The unemployment rate is in red, okay? So stagflation is when inflation goes up and unemployment goes up. Okay, this is what they're talking about in the 70s about stagflation. And it doesn't happen very often. It basically only happened twice going back to 1970 in a really bad way, twice. But that's pretty huge, right? You get huge spike in inflation and a big spike in unemployment. You don't see anything like that anywhere else on the chart, right? You get it right here, and you got it less of it, but you got it also right here in 1980. So where are we right now? You got inflation clearly falling. You got unemployment rising, but it's not rising, it's not spiking. It's not like this, right? It's not spiking. yet, maybe it will, maybe it won't. But it's not spiking right now. And inflation is falling. So if you're the Fed and you're trying to weigh this, if inflation is falling, it's because the economy is weakening, right? And so they're looking to lower rates, which is also what the administration wants. That should help with unemployment. If they lower rates and put more money into the system, it has the potential of creating inflation. But inflation is obviously falling and trending down. So I don't know. I'm sure there's a lot more to it than just the chart of the inflation and the unemployment report. But it seems like the concern ought to be more on unemployment. But at this point, honestly, unemployment's not that bad, and inflation's not that bad. So the Fed decided to keep the Fed funds rate where it is, which kind of makes sense. So if you look at it from the S&P 500 perspective, so 1973, right? We had a 50% drawdown during that oil crisis and the big stagflationary period. And everybody talks about it and they refer back to it. But that was actually this, right? That is not, that's not what's happening today. It could, but that's not what's happening right now. That's the concern, but it's certainly not what's happening right now. And during that time, the S&P lost 50%. So that's not happening right now. Might happen, but it's not happening right now. And then it takes a long time to recover from stagflation. That's probably the worst part of the whole thing, because basically from the top here in 73, it took until almost 1983 to get back to even. Right? We got back above it, rolled back down, came back up. We finally did a big breakout here in 82 and then kept on going. But it was a flat 10 years from the top in 73 to basically 83. And we had a whole bunch of, once we got going, right, boom, 16% decline. Got going again, boom, 21% decline. It's very, very difficult during periods of stagflation and long-term sideways market movements. If you're trying to, that's why they call it the lost decade. It's just really hard. All right. So that's kind of the bad news. The good news, the Zweig Breadth Thrust, which, yes, everybody was very giddy about. So they're talking about the New York Stock Exchange. So on April 24th, this is what happened. We have this thing called the Zweig Breadth Thrust. So Marty Zweig came up with this indicator, and it basically just says that when a share of the rising stocks increases from a moving average of less than 40% to more than 61.5% within a 10-day period. All that's saying is you had some number of stocks that are going up. Say it's 40%. If that number of stocks increases to 61% over a 10-day period, it's a huge increase in sentiment, right? It means all those stocks are rising over that 10-day period. Something's happening in the market in a bullish way. It's a rare occurrence. It's only happened 19 times in the last 80 years. It's considered a sign of increasing market momentum. It's driven by bullish sentiment. It's basically a sentiment indicator. So everybody got all excited over this 10-day period, and a lot of stocks, much more than the average, went up versus going down. Okay, that's basically what happened. So the signal has been 100% accurate. Ryan Dietrich is quite the perma bull, but the signal has been 100% accurate since World War II, with the S&P 500 higher 6 and 12 months later every single time. Looking at the last 19 Zweig Breadth Thrust signals, the S&P has averaged a 6-month return of 14.8% and a 1-year later return of 23.4%. So just on those stats alone, you would think it's a no-brainer, right? Every time you get a Zweig Breadth Thrust in the past 80 years, 6 months out, you're up 15%. A year out, you're up 24%. Then Tom McClellan comes in and says, well, in 2015, he took a look at breadth thrusts at the Zweig Breadth Thrust during the Great Depression from 1929 to 1934, found them to be much less reliable bullish signals. The first signal in this period came in November 1930. It did precede a strong upswing, but its bullish effect petered out over a couple of months, and the bear market was back on. And then over the next 2 years after that, 4 more of these breadth thrusts failed to break the bear market. So it's a bullish sentiment indicator, and sentiment is fickle. So, take it for what it's worth. There was a lot of sentiment, a lot of positive sentiment, bullish energy going into this rally that we've had for the past couple of weeks. It doesn't mean it can't peter out. And we're going to kind of get to that in a minute. This is Tom McClellan's a chart of it. This is Zweig Breadth Thrust going back, I guess, to 1998 here. But what I wanted to kind of point out is, yes, at significant bottoms, a lot of times you get a Zweig Breadth Thrust. You don't get it at all the bottoms, right? We didn't get it after COVID. We didn't get it here in 2002. Like it's not random, but it's strange when you actually get these breadth thrusts, and they don't always mean that the market's going to go much higher before it corrects again. And so it's a good indicator. It's a good stat, but not one of my favorites. All right, Bitcoin. So if you guys are a subscriber to the site, we have a thing called the forum. If you remember the site, you go in there and throw in ideas and ask questions and thoughts and things. And I put up this chart of Bitcoin April 21st. And it was an analysis, right? We talk all the time about the indicators, the 200-day moving average line, trend line, 20-day moving average line. So if you do an analysis of the chart, you connect to the highs, right? We're in this downtrend. We got support at the 200-day moving average right here. Came up, came down, retested the 200-day here. And then on the 21st, we did this big gap up. Actually, we got above the 20-day right there, did 4 days of consolidation, and then a big gap up, right? And the indicators were turning up. So that was the analysis of the chart at the time. The biggest takeaway for me, because if I want to buy something or reallocate in the TSP, I want to do it knowing what my risk is, right? We had 4 days of support there at the 20-day moving average line, and then we had a gap up. So if it got below that line, it was wrong, right? It was not gonna continue in the direction I wanted. Okay, so the risk is this much, right? And then if you fast forward to today, this is where this was that gap up right there. So as long as Bitcoin continues to ride along its 20-day moving average line, it's trending higher. So it doesn't always work. This time it worked out. It doesn't always work. But if you know what your risk level is, which was that much in this case, that's the best time to buy something or sell something when you're doing it for a reason. And so that's it. Hopefully some of you guys that are subscribers got to take a look at that in the forum. All right, TSP fund charts. So again, this is a weekly chart of the TSP funds. These are the actual numbers of shares, what the share price is in TSP. C-Fund tracks the S&P 500, but the TSP includes dividends, so the price looks a little bit different than the chart of the S&P 500 would. But a lot of these are coming out to be basically the same. This is the 20-week moving average line in blue and the weekly relative strength down here. That you're right on that coming up to resistance at that 20-week moving average line, and you're basically right at 50 on relative strength. So when you look, this is a decision point, right? You can look at that and say, okay, if it gets above the 20-week moving average line and we get above 50, I'm going to reallocate back into the stock funds. Why would I say that? Because if it rolls back over and closes, if it gets up here and then rolls over and closes below that 20-week moving average line again, you get out. So your risk is that much, right? You want to be able to identify your risk. That's what happened in 2022 several times, right? Just because it gets over that line doesn't mean it just keeps going. You get some whipsaws like this. Once it gets going, you're in pretty good shape, right? You get support there at that 20-week for long periods of time, but it's not a magic line. It's not like once you get above it, you magically stay there. This is a decision point. S-Fund, exactly the same, right? This is as of Thursday's close, but it's exactly the same. We're right just below that 20-week moving average line and just below 50 relative strength. So you can either say, I think it's going to hit resistance here, like it did right there and there, right? And rolled right over, right at the line. And it can definitely do that. Or it can break above it and keep on going, and we can have an uptrend like that. It's a decision point right there. So I'm just saying, this is the time when you should be paying attention and looking to make a decision. iFund is the best looking chart, right? It's gone straight up 1, 2, 3, 4 weeks. This week it's off a little bit, but it's the only one that's above its 20-week moving average line. You could have connected this as a down, probably connect that as a channel and have it break out of that channel. The iFund's looking much better than the C or the S funds are right now. And you're above 50 on relative strength. This was a huge move, so it would be nice to see a pullback and support at that 20-week moving average line. That would be a great entry point because we're pretty far overextended in the short term. But the iFund is looking really good. And the F fund, who knows? The F fund's really up to the whim of bondholders, and it's just not even moving. Every time the Treasury Secretary says something, the bond market moves, and it's obviously, we had a huge breakout here. The very next week, a huge breakdown there, and it's just been consolidating in between. So, and then the G fund up and to the right.
Up and to the right, where it always goes. I find the bond market very interesting right now because it seems like so many fixed income people, bond market, want it really to start moving, right? They want it.
One way or the other.
Doesn't mean that it's going to, right? Because a lot of them have, some of it's my opinion, some of it is based on the research that I've seen lately with a lot of people when the market started going down, using kind of the old school thought. A lot of money managers, I hate to even call them money managers because some of them really don't manage money, but that's another thing. But anyway, giving advice to clients, basically, hey, now may be the time to move more into bonds because it's just that normal kind of, I don't know what else to say. I didn't tell you the bond, I didn't notify you that the stock market was gonna take a downturn. Therefore, my answer needs to be something, and let's move into bonds. So a lot of people are wanting bonds to work right now, and bonds don't care.
No,
they really don't. Like you said, it's all over the place, and the whole idea that just because the stock funds are going down, that the bond funds will go up. It's not working like that anymore. So you have to just toss that out the window, which really, kind of, if you have a money manager out there, an investment advisor, whatever you want to call it, if they're managing your investments, right, for you, and they're trying to sell you on this 60-40 idea or bonds go up on stock, if you hear any of that talk, I'd go find another advisor because that means they really don't know what they're talking about and they're just kind of relying on the script, right? And a lot of them are because it's easier that way and somebody tells them what to do.
Yeah, they buy an algorithm and they follow the algorithm.
That's it. So I look at that as a red flag, when somebody's doing that now, and I'm like, okay, well, you're not in tune with what's really going on in the financial industry if you think bonds go up when stocks go down. That whole, narrative that we've been sold for 40 years, 50 years at least. And that it was historically true, right? If you go back far enough, but hasn't been that way for a while. So you have to accept that and stop ignoring it. But anyway, I've had a couple of rants this podcast. But it really bothers me when I see investment advisors just give it a blanket advice like that and say, oh, here's what we're going to do. And because it just matches up with anything you're able to Google or whatever. And that's not good stuff for people. But anyway, I hope you guys enjoy the podcast. If you do, please share it with your friends. We've had an uptick in subscribers on YouTube, so something's working well. I hope you guys are sharing it.
Cool.
It's always, we don't get paid by YouTube or anything, but it's nice to see more people watching. If you have questions about anything that we talked about during the episodes, please put it in the comment section. We check all the comments for the videos. Sometimes it takes us a couple of days to get to it, but we do. And if there is no comment section, you can always shoot us an email at support@growmytsp.com. All right, guys, check our website out if you haven't, and we will see you guys next week.